We are talking about reverse mortgage, which I think is one of the most maligned products in the mortgage industry, wrongfully so. Incredible tool to help you to further your retirement, to make sure that you don't run out of money before you run out of life. Harlan, welcome back, number one.
Yes, sir.
And can you kind of give us a simple way to understand how this reverse mortgage works? What are the options?
Well, remember what we were talking about before about the three buckets.
Right.
So when
which
you're
is income, retirement savings, and equity in your home.
Exactly.
Okay.
So when you're under the age of 62 and you're working, you take money out of bucket number 2 and you dump 5 to 20% into bucket, or you take money out of bucket 1 and you dump money into bucket 2 for your retirement savings, 5 to 20%.
Right.
But what you're also doing is you're dumping money into bucket 3, your house.
Yes.
Sometimes it's 30, 40%, depending upon how big your house payment is, $2,000, $2,500, whatever. You're dumping in your taxes, your insurance, you're paying off your mortgage, you're doing maintenance on your house. You're putting a tremendous amount of money into bucket 3. But when it comes to retirement, people say, oh, okay, now my income went down in bucket 1. I've got to draw in bucket 2 because everybody has been told from the time they're young that you put money away in bucket 2 in your IRA, so you take money out at the end. But all the reverse mortgage does, in very simple terms, is we just make liquid bucket number 3 without you having to move out of your house and release some of that equity that you have poured in for the last 10, 20, 30, 40 years that you've been in the house. So when you pull the money out, you can either pull it out, as we've already mentioned, in a lump sum to pay off an existing mortgage.
Right.
The second way you can get money out is a monthly payment. So if you don't have a mortgage and you have your house paid off, you can take out a monthly payment where the house pays you back just like you paid for the house.
So wait, let's make sure we understand this. That's not a monthly payment that I'm making to someone else. That's a monthly payment that they're making to me as a
That's exactly right.
Holder. That's a great concept.
So depending upon the value of your house and depending upon your age and the current interest rate, those things all go together and say, okay, you are now eligible for $1,500 a month for life. The third option is you can do a line of credit and say, I don't know how much money I need. I might not need any this month, but I might need more next month because I want to do some repairs or go on vacation or whatever the situation is.
Help the kids with college, grandkids.
Exactly.
Who knows?
So that the money is just sitting there, and it's very different than a regular line of credit. A lot of people say, well, I'll just go get a line of credit at my bank. That's the same thing. Not even remotely the same thing. It's a line of credit that is guaranteed never to go away, never to require a payment. And furthermore, it grows by over 5% a year. Every bit of money that is not used grows every single year, no matter what. Even if you live to be 90, even if it increases above the value of the house, even if we're in a housing crash in 2008, the line of credit continues to go up no matter what and is always available. One of our clients wanted to help build an unwed mother's shelter for his church.
Sure.
He didn't need it.
Right.
So he just pulled all the money out and donated it to the church so they could build the unwed mother's shelter instead of giving the house to the church at the end of his life.
So you can help, you potentially could use this to help that legacy or to give back to the community.
I really look at it as the parable of the talents.
Yes.
Why keep it hidden in the ground when there's something you can do with it while you're alive?